unceded territories of the coastal Salish people, including the Musqueam, Squamish, Tsleil-Waututh nations. We recognize their enduring presence on these lands and their rich cultural heritage that shape the past, present, and future of this region. We honor the traditional stewards of this land and strive for reconciliation, respect, collaboration with Indigenous people, and our ongoing efforts to build a just and equitable society. I would like to welcome our guest speaker today, Senior Deputy Governor of Bank of Canada, Carolyn Rogers. Welcome. We would like to welcome our members, advisors, MGA partners, and insurance carriers. We would like to thank our event sponsors today, Financial Tech Tools, Vidéo Financiers, Richardson Wealth. Without them, we would not be able to make this event happen. Special thanks as well to our Greater Vancouver Chapter Platinum sponsor, Canada Life, Manulife, and PPI, our Gold sponsor, Desjardins, and our Silver sponsor, Foresters. I would like to express my gratitude to the Greater Vancouver Advocis Chapter Program Chair, Angelina Hung, and her committee members for hosting, organizing, and delivering this event for the benefit of our members and the community as a whole. Advocis is the largest voluntary professional membership association of financial advisors in Canada. Advocis offers designations, programs, continued education, opportunities, industry-leading publications, and membership in a chapter network that includes mentorship, study groups, practice development, and more, such as events like this. Advocis chapters deliver a meaningful member benefit at the local level that supplement and strengthen the benefit provided to all members via the National Advocis Organization. Chapters focus on strategic drivers of professional model, sustained Advocis membership. Supporting members' needs for advisor success are as follows. 1, education initiatives that advance professionalism, designation achievement, and that help advisors evolve their practice. 2, advocacy awareness and engagement, strengthening the voice of advisors within the industry in provincial and federal advocacy activities. Number 3, community through both face-to-face and virtual initiatives that promote fellowship, collaboration, mentorship, and community leadership. Number 4, professionalism. All Advocis members abide by a professional code of conduct and ethics, and we hold ourselves at a higher standard. Advocis proudly continues more than a century of serving financial advisors and their clients. Our featured speaker today is Carolyn Rogers. Carolyn Rogers was appointed Senior Deputy Governor of the Bank of Canada in December 2021 for a 7-year term. She shares responsibility for decisions with respect to monetary policy and financial system stability. She's also a member of the bank's board of directors. At the time of her appointment, Ms. Rogers was Secretary General at BESO Committee of Banking Supervision. From 2016 to 2019, she was Assistant Superintendent, Regulation Sector of the Office of the Superintendent of Financial Institutions, who we're all familiar with very well, where she was responsible for policy-related functions, including capital, accounting, and legislation. Before OSFI, Ms. Rogers served as the Superintendent and Chief Executive Officer of the Financial Institutions Commission of British Columbia and chaired the Canadian Council of Insurance Regulators. She is also a founding member and past chair of the Credit Union Prudential Supervisors Association. Born in Winnipeg, Manitoba, Ms. Rogers is a chartered professional accountant with degree from Brandon University and Queen's University. Thank you for joining us today. Senior Deputy Governor, Carolyn Rogers will be speaking about financial stability in an era of higher interest rates. Please help me welcome Ms. Carolyn Rogers.
Good morning, everyone. Bonjour tout le monde. I have to make a few remarks in French, being from Ottawa. Well, first of all, thanks to Advocis for the invitation. Thanks to all of you for being here, for navigating what I've heard from many of you was a tough traffic day in Vancouver. And thanks for the kind introduction, Andre. I want to make just a couple of introductions of my own before I get going. I have some colleagues with me from our Ottawa office, Paul Badisher and Claudia Gobu over here. I also have Callista Chung, who leads our Vancouver office for the bank. So very happy to have them here with me. And I'm really happy to be back in Vancouver, even on a kind of dreary November morning. And good to see a few familiar faces in the crowd. I'm also particularly glad to have the chance today to speak to a room full of people whose profession it is to help Canadians navigate financial decisions. The combination of inflation and higher interest rates, I know, are making for some tough financial decisions these days, and advice from professionals like you becomes all the more important. So I'm looking forward to hearing from you later this morning. The Bank of Canada's main job is to control inflation, but we also play a very critical role in promoting the stability of the Canadian financial system. And every spring we publish what we call the Financial System Review, or the FSR, which outlines risks and vulnerabilities that could test the system's resilience. We also update Canadians on financial stability issues in a speech every fall, which is what I'm here to do today. And given the forceful response by central banks since early 2022 to get inflation under control, this year's FSR focused on the adjustment of the financial system globally and here in Canada to the large and rapid increase in interest rates. Since the FSR, we've seen more evidence that the financial system is continuing to adjust, but there's more adjustment to come as past interest rate increases work their way through the financial system. Your view of current interest rates probably depends, at least in part, on your age. On one hand, if you had a mortgage in the 1970s or 80s, today's rates may not seem that high. On the other hand, if you're a young person buying a home today, you're facing some of the highest borrowing costs you've ever seen. In either case, we've all been through a pretty lengthy period of very low interest rates. Before rates started rising last year, they'd been unusually low for a very long stretch of time that started around the 2008-2009 financial crisis. And it could be very tempting to think that rates will not will return back to those very low rates. But there are reasons to think they may not. On aimerait revenir au bas taux d'intérêt, mais ce n'est peut-être pas possible. Adjusting to a world of higher interest rates would be a big change for everyone in the financial system, from governments, businesses, households, investors, and financial planners. Financial stability and resilience are all about adjusting to change, gradually and proactively. Adjusting early and bit by bit lowers the risk that having to take more abrupt and possibly destabilizing effects later on. So today I'm going to talk about why it's important for the stability and resilience of the financial system that people plan for and adjust to a potentially higher interest rate environment. I'll touch briefly on why we could see ourselves in such a world going forward, and then I'll talk a bit about some of the adjustments we're already seeing and what we could see as the process continues. I'm aiming to be brief, about 15 minutes, so we've got plenty of time for questions and discussion later. Let me start, though, by saying that the bank's monitoring of the financial system does not lead to a forecast of likely outcomes for the financial system or for the economy. So I want to be clear that when I'm talking about interest rates today, I'm not making predictions on the path for monetary policy. I'm not here to tell you whether our policy rate has peaked or when it will go down. What I will share with you are those factors that we see as having an impact on the direction of long-term interest rates, some of the reasons we could see rates stay higher for longer, and why it's important to adjust for that possibility. The bank's policy rate is currently at 5%, but from the global financial crisis through the first 2 years of the pandemic, The policy rate was close to zero much of the time, and it never topped 1.75%. And a range of interest rates that affect borrowing costs in the financial system trended downward for several years. My former colleague Paul Beaudry spoke about the reasons for this in a speech last June. He described the structural forces at the global level that, for many years, combined to push long-term interest rates lower in Canada and in advanced economies around the world. These forces included aging baby boomers who were saving more, China and other developing nations joining the global economy, and fewer attractive investment opportunities for businesses. Paul also explained that some of these forces look to have peaked and could start reversing. And this, of course, would put upward pressure on interest rates. We also now look to be in an era of higher levels of government debt, and geopolitical risks, such as an escalation of the war in Ukraine or the war in Israel and Gaza, could push rates higher globally if they were to affect energy prices and supply chains in ways that would have a lasting impact on inflation. Obviously, this involves a lot of uncertainty, but it's not hard to see a world where interest rates could be persistently higher than what we've all grown accustomed to. Globally, the adjustment to higher interest rates is well underway. Risk-free, long-term rates in a range of major economies have risen by about 300 basis points since mid-2021, when global inflationary pressures first started to build. It's become more expensive for individuals and corporate borrowers to service their debt. At the same time, financial institutions are facing higher funding costs. This all leaves less wiggle room for the global financial system if a shock, such as an abrupt tightening of financial conditions, were to occur. And we have seen some of these shocks already. There was the stress in the UK gilt market last fall, and then, of course, there were the stresses that emerged in the US and Swiss banking sectors this past spring. Both episodes were triggered in part by sharp rises in bond yields that caught parts of the financial system off guard. Those earlier stresses didn't lead to stress here in the Canadian financial system, but as a small, open economy, Canada would likely not be immune if severe global stresses were to reemerge and persist. As we outlined in the FSR, such stress could interact with existing vulnerabilities like high household debt. To make sure that the Canadian financial system remains resilient, proactive adjustments to higher interest rates need to continue. We know from the data and from responses to our surveys that Canadians are adjusting, and they're feeling some pressure as they juggle the combined effects of inflation and higher interest rates. The pace of credit growth among households has slowed considerably since the bank started raising interest rates. In recent months, household credit growth on a year-over-year basis has been about 3%, which is at the slowest pace since the early 1990s. We've seen a big drop in applications for residential mortgages, while banks' mortgage approval rates have remained roughly unchanged. This suggests that the slowdown is being driven primarily by a drop in demand rather than a tightening of credit standards. That lines up with the slowdown we've seen in consumer spending, especially on goods that people typically buy on credit. While households aren't adding to their debt levels as much, some are finding it harder to deal with existing debt. Delinquency rates on credit cards, car loans, and unsecured lines of credit have either returned to or slightly surpassed pre-pandemic levels. And some households look to be relying more on credit cards. The share of accounts with a utilization rate higher than 90% has been increasing. Delinquency rates on mortgages, meanwhile, are still lower than pre-pandemic. And to date, households with mortgages are showing only a modest increase in financial stress related to their non-mortgage debt. For businesses, the pace of credit growth has also slowed, and as with households, the slowdown appears to be driven primarily by a drop in demand. Many businesses have seen their debt servicing costs rise at the same time as their revenue growth has been slowing down. However, the data so far suggests that most can still service their existing debt and while business insolvencies have risen across most industries, they're still largely in line with levels seen before the pandemic. The banking sector is also adjusting. As interest rates have risen, banks have raised the rates they pay on term deposits, with one-year rates for GICs above 5%. And this room would know that's about the highest level in more than 20 years. Depositors, of course, have reacted by shifting money from demand deposits to higher-paying term deposits. This is good news for savers, but it also means higher funding costs for banks, and higher funding costs are typically passed on to borrowers. Banks are also keeping larger capital and liquidity buffers than before the pandemic and putting more cash aside to deal with potential credit losses. This, of course, helps them prepare for the effects of a slowing economy and is exactly the sort of proactive adjustment that we'd expect to see. So that's the story so far, but there's more adjustment to come. A key area that we're watching is high levels of fixed payment mortgage debt. In all, about 40% of mortgage holders have seen their payments adjust since early 2022. By the end of 2026, virtually all remaining mortgage holders will go through a renewal cycle, and depending on the path for interest rates, may face significantly higher payments. In combination with credit stress indicators, our consumer surveys help us gauge how Canadians are adjusting or planning to adjust to higher payments. Many respondents say their mortgage payments are close to or greater than the maximum they could handle without cutting other spending. And most say they think the impact of higher interest rates is no more than about half done. Despite greater financial pressure, though, most mortgage holders still expect they'll be able to manage higher payments. We see a similar dynamic in the response to our business surveys. Our latest Business Outlook survey in our latest Business Outlook survey, just under half of the companies we spoke to said that they think the impact of higher interest rates is just beginning, and another 30% said they think it's about half done. Even so, most businesses say they're confident they can manage their debts despite the added pressure. It's early, though, and the effects of higher interest rates are still working their way through the economy. We'll need to keep a very close eye on both credit stress indicators and survey data to gauge how businesses and households are adjusting. It's time for me to wrap up now so I can hear from you. My objective today was not to offer a prediction on the path of interest rates. Rather, what I hope to do was give you a sense of some of the things that may affect longer-term interest rates, and particularly to stress the importance of adjusting proactively to a future where interest rates may be higher than we've seen over the last 15 years. The bank will continue to monitor the impact of higher interest rates on the economy and will continue to update Canadians on what we're seeing. La banque va continuer de surveiller l'impact des taux d'intérêt plus élevés sur l'économie, et on va continuer de tenir les Canadiens au courant, and will remain focused on bringing inflation the rest of the way to our 2% target so that Canadians can save, invest, and plan with more certainty. Thanks for your attention, and I look forward to your questions. See this here.
Thank you very much for that insight. We really appreciate it. And as we transition to our Firesight Chat and introduce our moderator, I do like to acknowledge our table sponsors today and make sure that PPI, Canada Life, RBC, Insurance Hub Financial, and IDC Win are acknowledged as well. I would like to welcome our moderator, Angelina Hung. She is a self-acclaimed financial marketing nerd. Angelina is a highly experienced professional with a background spanning over 20 years in financial services, marketing, technology, and design. With a track record of excellence, she has earned her CFP, COU, CHS, and EPC designations. She is known for providing financial advisors with investment and insurance content on their latest digital marketing strategies to grow their business. At Financial Tech Tools, Angelina combines her knowledge and expertise to provide advisors with digital marketing solutions, which can help them save hours creating content for their websites. This offering has positioned Financial Tech Tools as a leading provider in the digital marketing space, working with hundreds of advisors across the country. She has been recognized for her outstanding achievements, and she's been featured as one of the top 50 women influencers in Canada in the Insurance and Investment Journal. Angelina holds position on both the Advocis Greater Vancouver chapter and the Advocis Technology Innovation Committee. Angelina, take it away.
Thank you, Andre. And special thanks for all of you for attending today. So we've got a whole bunch of questions, and it's going to be a little bit of a variety of questions, Carolyn.
Sounds good.
So let's start off with housing, because it's such a hot
Because I'm in
topic.
Vancouver, so we're going to start off with housing.
Yeah, you're in Vancouver, right? So, well, in BC, we know that housing costs are a significant problem. There was a recent report actually from the National Bank of Canada that showed that it's actually even tougher for people to afford homes nowadays. Now, the report said that there are many current homeowners that are having a hard time, and some of these folks aren't even sure if they'll manage to buy a home. So, and one of the reasons that were listed was for difficulty is the increase in interest rates. So how concerned are you for Canadians who have, obtained mortgages with lower interest rates, but now must renew with much higher rates in the near future, in the next upcoming years and months?
Yeah, it's a good question. So, I think the first thing I'd say is we are acutely aware that the pressure that higher interest rates are putting on Canadians. And particularly new home buyers or aspiring home purchasers. Mortgages are one of the first places you see monetary policy start to work. Most of us buy a house on credit, and really what monetary policy is designed to do is affect the use of credit in the economy. So mortgages are sort of one of the first places you see monetary policy, and one of the places you see it the strongest. So we pay close attention to the mortgage market. What I would add, though, is some important context. In Canada, a little below 40% of people have a mortgage, and then there's about 25% who own their home outright, and then there's a big chunk in the middle that rent. And so it is important to focus on the mortgage market, but what I would say is at the bank we focus on the entire economy and all Canadians. And so right now, the thing that people tell us that is the toughest on their financial situation is inflation. So inflation's certainly affecting the people who have a mortgage, and it's affecting the 60% who don't have a mortgage too. So I think the most important thing we can do to support Canadians who are struggling with the pressure the current financial situation is to get inflation back down. And when we get inflation back to target, well on its way to target, we can move from a fairly restrictive stance on interest rates and hopefully get back to a more sort of neutral stance, which will also help people with mortgages, and it'll help aspiring home buyers too.
So that actually leads quite well into my next question with regards to first-time home buyers. So at the start of the pandemic, the interest rates were lowered to really spur on lending. And as a result of that, there were increased home prices. And yet with the Bank of Canada rate increases, we haven't seen the home prices drop. Really for those Canadians who are still looking to buy their first home, with higher interest rates and having a reduced borrowing power of about up to 40% in some cases, and housing prices that have remained elevated. Could you explain to us why some prices have remained elevated? And also, does the Bank of Canada actually consider the impact of higher interest rates on mortgage qualification?
Yeah, well, I think what you're seeing across Canada, in some sense, is what this city has experienced for probably 15 or 20 years now. So I know back when I was working here in Vancouver in the financial sector about 15 years ago, we were at that time worried about housing affordability. And there was a strong sense that one of the things that was affecting housing affordability was the number of buyers from outside Vancouver, either people migrating from other parts of Canada or from outside of Canada. And so there were a number of steps taken to affect that source of demand for housing, right? Housing prices stayed elevated. So, I mean, you know, what you had now and what you still have in Vancouver is a huge demand for housing and a constrained amount of supply. Now, of course, you combine that over the last 15 years, as I talked about, a period of low interest rates. So low interest rates usually mean house prices go up. Anything that you buy on credit sort of has an inverse relationship to interest rates. So the combination of those two things kept housing prices up. And then, of course, we entered the pandemic, and both of those factors are accentuated. We have an even greater demand for housing. We're all locked in our houses for days on end, so we want more house or different houses or different location. And we have even lower interest rates. And so we had a real run-up in house prices, on average 50% across Canada. Now, we've had a big increase in interest rates since then, so you would have anticipated maybe erasing all of that gain, but we haven't. And I think, you know, our view on that is what we have is a structural supply problem. So we can move interest rates around, it will have some effect, but really what we need to address is the supply problem. So, you know, again, going all the way back to you know, the dynamics here in this market, we've taken a number of policy actions over the years to affect demand for housing, and we still have a housing affordability issue. So, you know, we are really glad to see the degree of attention this is getting from all levels of government, and you know, we need some coordination on that. We need some action. I think if we can address the supply issue, that's our best route to housing affordability.
Thank you, Carolyn. Now, just to change gears a little bit, we're going to talk a little bit about a recent poll that was conducted by Advocis for Financial Literacy Month. Now, in that poll, over 40% of respondents actually indicated that their clients have been late to make a monthly credit card or mortgage payments. And 47% of those respondents indicated that they've actually seen clients get a loan to purchase or refinance a car, and some even went as far as selling personal items to help support their, you know, their monthly bills. Now, because Advocis is an association of financial advisors, our members handle the finances of many Canadians, and numerous advisors have actually noticed that a lot of their clients are really struggling. Now, one of our advisors has actually said he's seeing a lot more pain than what the government suggests. So why does it sometimes seem like the government inflation figures and the economy doesn't match what regular people are going through in Canada?
Yeah. Well, as much as we roll all the data up into one CPI number, no two people experience inflation the same way. Every household's different, right? So if you're feeding a family of 4 or 5 kids, you're buying a lot more groceries than somebody who's just a single person, for example. If you're commuting 2 or 3 hours every day, you're buying a lot more gas than somebody who just walks to work. If you're renting, you've seen your rent go up 15, 16%. Your interest payments have gone up if you have variable debt. So it really, you know, it really depends on what your basket of goods is the term we use as an economist, what your basket of goods is. That's how you experience inflation. And so, and you know, we've seen some of the most sticky inflation we've seen is in food. And we all buy food. Nobody can avoid.
I noticed it on my Costco bill.
Right? Yeah, yeah. So I think, you know, you can look at the headline number, and I get why people think, well, it does not feel like 3.8 to me. I still feel like prices are going up a lot, and it really depends on, you know, what is your basket? What is your experience with inflation? So I think that's one answer. The other answer, and I think it's important, you talked about a survey, and you heard me in my speech talk about, you know, we look at what we call credit stress indicators, which are sort of, they're really more about the loan, not the person who has the loan. So the loan could be completely up to date, but the borrower could be feeling very stressed, and you'll get that in a survey. You might not get that in the stress indicators, credit stress indicators. I mean, people are making tough choices. So they could be completely up to date on all of their payments, and they're not going to show up if we're just looking at credit stress indicators, they're not going to show up necessarily. But that's why I think the surveys we do, we pay attention to the surveys that the organizations like you do too, because that tells us how people are feeling.
Yeah.
Yeah.
Thank you. Let's talk a little bit about small business and productivity.
Let's do that.
Yes. So as of 2021, small business employed 8.2 million individuals in Canada, and that's 2/3 of the total private labor force. So a lot of us in here are small business owners, myself included. I can see so many business owners in the room. And Governor Tiff Macklem talked about the need to increase our productivity, and how each person in our country doesn't actually generate as much economic output per capita. And we have a nation that is actually weak in national productivity and low in capital investment compared to the G7 and OECD nations. This is not news to you, I'm sure. So how can the Bank of Canada work with the federal and provincial governments to change our country's focus away from mainly being a destination perhaps for education where it causes a lot of people to leave, or spending too much on expensive housing that doesn't really contribute much to the economy? Instead, how can we actually encourage people to invest in new ideas, businesses, prioritize innovation, and improve our nation's productivity? What can we do to close that gap?
Yeah, it's a really important question. I mean, productivity is that really important ingredient that raises everybody's standard of living. It's how we build wealth as a country. It's how we get ahead. And in an environment where the labor market is tight and we have other upward pressures, productivity becomes that much more important. Productivity pays for higher wages. It's a really, really important ingredient to grow the economy. Through the pandemic, there were lots of things that were getting in the way of productivity in all forms of businesses. So we were really optimistic when we came out of the pandemic that we might see sort of a surge in productivity. We haven't seen that yet, and it's perplexing really, because we have a lot of the foundations in Canada for better productivity. We have a highly educated population, we have high labor force participation, but as you pointed out, we don't have the level of investment we need in machinery and equipment, in innovation, in training, that sort of thing. So it is an important area that we need governments to focus on, particularly if we're going into a period where we have tight labor markets and things like that. This is really the solution that we need, to build wealth and to build prosperity for Canadians. The bank, we don't have a lot of direct tools to affect productivity. We talk about it a lot when the governor and I are talking to parliamentarians at the Senate or House Finance Committee. This topic comes up. We're always glad to talk about it. But a central bank's tools are really more designed to target demand in the economy, and boosting productivity really requires building up the supply side of the economy. So we'll keep talking about it. I'm glad to hear you're talking about it, but it does need to be a focus going forward, for sure.
Especially for us all as business owners in this group here. It's encouraging to know that you guys are very focused on that. Yeah. Just to follow up, how does the arrival of over 1 million new people into our country, how does that impact productivity?
Well, let me maybe step back from productivity specifically and just talk about the effects of immigration on the economy more broadly. Mm-hmm. It's difficult to sort of parse it out and say immigration affects any one factor in a particular way. But I mean, immigration does really two things. First, and really importantly, it brings in added workers. And we've had a really tight labor market, so businesses need to bring in labor from outside of Canada, and they contribute. We're good in Canada too at integrating people into the workforce. So that's a plus. That adds to supply. But of course, when people come in to the country, they need to buy homes. They need healthcare, they need education, they need all of the things. So they add also to demand. And there's a bit of a timing difference too. When they first come in and they're getting settled in the country, there is a big boost to demand. And then gradually, as they're integrated into the workforce, they add to the supply too. So there can be a timing difference. Just back to your first question, though, on productivity, what we do know in Canada is we are better at growing by adding people. We are not as good at boosting the productivity on a per-person basis. And so if we could be good at both things, we'd really have some magic there, right? So we really need to work on the types of investments that help individual employees become more productive. And that's, additional training, investments in technology, in equipment, that kind of thing.
Thank you. We're switching gears a lot today, but that's because we have a limited amount of time with you. Let's talk a little bit about digital currency. Now, I know that the bank has been looking into a digital version of a Canadian dollar, or CBDC. What's the latest on this project?
Yeah, good. Glad to talk about that. What I'd start with doing is sort of going back to some of the lesser known things that the Bank of Canada does. I mean, I think everybody's been kind of focused on our role as monetary policy. And today I was talking a little bit about financial stability, but the other really important job we have for Canadians is making sure that we keep pace globally with payment options. Mm-hmm. So we produce the banknotes that you have in your wallet, if you have bank. Not everybody has banknotes in their wallet anymore, but that is one of the forms of payment we look after. We also, I was telling some folks down at a table just before we got going today, we're also responsible for all of the payment infrastructure that you never see, you never think about it. It's all the technology, the kind of plumbing that makes sure your payments that are happening every day, day in, day out, are settling and clearing and that kind of thing. So our job is to be thinking, 5-10 years ahead about how Canadians want to pay. And what we've seen for sure over the last few years is Canadians increasingly want to pay with digital forms of payment. So, and you sort of think, well, I've got lots of options already. I've got 4 or 5 cards in my wallet. I almost never use cash. I have lots of digital options to pay. But you don't have, at this point, an option to pay that's digital, that's equivalent to cash, so that has some of the benefits that cash has, but is digital. So that's really what we're exploring. It is out there. It's not, like I said, most Canadians sort of look at us with a kind of a puzzled look and say, but I already paid digitally. I don't need another digital option. So we just did a big, broad consultation with Canadians. We had a high level of response. And really the goal there was to ask Canadians, if you were to think about using a digital form of cash, what would it need to look like? How would it need to work to be appealing to you? So, and really what Canadians told us is it has to be a lot like cash. It has to have the convenience, the privacy, all the things that I like about my cash would have to be preserved if you went forward with a digital form of cash. So that was really good feedback. That'll help guide the research that we do. The bottom line is the decision to issue a digital form of the Canadian dollar isn't a decision that the Bank of Canada makes. It's made by Parliament, so it's really made by you through your parliamentarians. So Canadians will decide if we want or need a digital Canadian dollar. Our job is to do the research and the development and the thinking around it so that if they do make that decision, we're ready.
So very interesting, because that wasn't quite on my radar till my more recent research. So thank you for sharing that with us. Let's talk a little bit about quantitative tightening. So on October the 25th, it was stated that the Bank of Canada will continue with their policy of quantitative tightening. What needs to happen for the Bank of Canada to consider quantitative easing again? Well, quantitative easing is really we would think of it as sort of an emergency tool, an extraordinary tool. Mm-hmm. The pandemic was the first time the bank used that emergency tool. So really what quantitative easing is when interest rates are already at sort of their lower boundary level and we want to sort of keep them there or push long-term interest rates out, we actually go out and buy bonds in the market, and that extra purchasing, that extra demand out there helps keep interest rates lower.
we're not in that world anymore. We're not at the effective lower bound, and we're not in an emergency situation. So those are not conditions under which we would be using quantitative easing. In fact, where we are now is back to sort of normalizing our balance sheet. So all those bonds that came onto our balance sheet through the quantitative easing phase are now maturing and rolling off. So we call that quantitative tightening. So, yeah.
And then in the latest monetary policy report, it was again mentioned that inflation might return to target around mid-2025. Now, given the uncertainties and revisions in the economic outlook, how confident are you in the time frame, in this time frame? And with this in mind, can you provide us insights into when the Bank of Canada, I know you're smiling because you know what question I'm going to ask, when the Bank of Canada will actually consider putting a halt to interest rate hikes, and any potential timeline for lowering interest rates in the future? Yeah. I can see totally.
I knew I wasn't getting out of the room without that question.
I know. I'm sorry.
Exact dates.
Yes. Yeah. We'd love to have exact dates, but we know that's. Well, you know what? Let's just turn off that webcast. Yeah. And then you tell us in secret.
So look, for sure, it's been a tough forecasting environment these last couple of years. But every time we put out a monetary policy report, you have our best forecast with all of the information we have at that time. Yeah. So the forecast that you cited, that is our best forecast. What we did also say, though, is the risks to inflation have increased a bit. Yes. But having said that, we are seeing monetary policy starting to work. We are seeing the sort of underlying forces of inflation starting to reduce. The economy is coming back into balance, supply and demand balance, so that the pressure on prices is easing. We're seeing, we were seeing sort of pretty accelerated wage increases earlier in the year. That's starting to come off. We're seeing corporate pricing behavior starting to normalize a bit. So there's lots of signs there that we're well on our way. What we need to see, though, is we need to see those signs start to translate into core inflation coming down. We really need to see that number start to come down. As we said in our forecast, we think that's going to take a while. We need a bit of patience. We think it's going to hover around 3 or just above 3 into early next year, and then start to head back to the 2% target mid-2025. But there's risks with that, for sure. We are not yet talking about reducing rates. We need to see inflation well on its way back to its target. Monetary policy is forward-looking, so we don't need to see it go all the way back to 2% before we're going to start talking about reducing rates. But we do need to see and be confident that momentum's going in the right direction. And the good news, as I said earlier, is when we get there, when we do see inflation well on its way back to target, that's when we'll start talking about moving from a more restrictive policy stance, higher rates back to something lower. But we're just not there yet.
Thank you. And just our final question for our Fireside Chat, so if you guys have questions ready, please get yourselves ready for our live Q&A. What's the most important thing you want everyone in the room to remember from our discussion today?
Well, I'd probably use maybe an overused phrase over the last couple of years, but we're heading for a new normal. We've had to do a lot of new normal over the last few years. New normal about how we work, new normal about travel, all kinds of things. Yeah. We're definitely in a new normal financially too. So you guys have a really, really important job to work with your clients and help them prepare and think about an environment where interest rates are higher than we've seen or than we've gotten used to in the last 15 years. So it was a real privilege to be able to speak with you, and looking forward to hearing from you. But that would be, for this group, that's the important thing I'd want you to take away is please use that privileged role you have with your clients to help them adjust and prepare to a future where we may have a higher interest rate environment.
Well, thank you. Thank you, Senior Deputy Governor Carolyn, for all your insights. So at this point, we will now move on into the live Q&A. So if you have any questions, please raise your hand. And oh, we've got questions already. Okay. So, and we've got Suzanne and Sela. So that will be coming to you with the mic. And then prior to asking your question, if you could please state your name and affiliation, that would be great. Go ahead, Tony.
Good morning. Thank you for your time. Tony Chang with Desjardins Investments. Question is lag time. We talked a little bit about increasing interest rates and what the lag time is. What we're seeing is maybe a potential softer or mild recession. We have a lot of small businesses that may teeter over the next 12 months. If we do see that teeter into more of a normal recession, and we see the Bank of Canada starting to cut rates because we're experiencing that across the board, what is the lag time for those small business people or entrepreneurs to come back into the market, start to deploy more capital and hire more people?
Yeah, I mean, lag time is something we've talked a lot about over the last years. We raised rates quite aggressively, right? And normally we think of the lag time for monetary policy to be something around 18 months. So if you think about sort of the path of interest rates, we've still got, as I said in my speech, we've still got some tightening to come, we think. There's a number of things that we think have had an impact on what would be a normal lag time for monetary policy. Through the pandemic, Canadians actually built up some excess savings. So I think that has, we think that's buffered a bit the effect of interest rates on people. Here in Canada, we have more fixed rate mortgages. Now, we did see an uptick in variable rate mortgages through the pandemic, so those the transmission tends to be quicker. But we're looking at that pipeline of mortgages I mentioned in my speech, so we know there's still half of the stock of mortgages out there haven't renewed yet. So there is a lot of lag time. I mean, your question about when do people sort of go out and come back in, that's a difficult question for us to answer. I mean, I think what we're watching for, and we're trying to be forward-looking as we think about policy. So we don't wait to see everything materialize. We look for those indicators, and we try and sort of react in a forward-looking manner.
Thank you. Yes.
Hi there. My name is Kathy Hurlbird. I'm a financial planner with many designations, and I'm with Asante, and I'm an Advocis member. Thank you for putting this event on. As you well know, Canadians have a substantial amount of their personal wealth tied up in their homes. Mm-hmm. And I keep hearing the federal government, and you said today, affordable housing. And I would like to know if anybody has thought about the impact of the existing homeowners. Not that they should have priority over people who don't yet have homes, but I think that affordable housing will result in a lot of our clients losing substantial wealth in their homes, housing prices actually coming down. And I don't think that the Canadians understand that's maybe the result of that sort of progress. So I think we should be preparing our clients for that. I'd like your comments.
I mean, I think I'd say I agree with you. We talked about the effect on home prices of changes in interest rates. We would normally have anticipated quite a bit bigger change in house prices given the change in interest rates we've seen. We haven't seen that, and as I said, I think that's in large part because we have a structural supply problem. It's going to take a while to fix that supply problem. We do expect house prices will likely come off a bit more. But I mean, I think your point is to the degree that people view their wealth through the lens of their home value, that's an important thing to consider for people like you. Yeah.
Thank you, Carolyn. Keith Brown.
Hi there, that's my name, thanks. And good morning, Carolyn, thanks for your comments.
Keith, can you bring the mic up?
I have a few comments.
Okay.
A lot of wage pressure, obviously the most the highest increase in wages for the auto workers in any union negotiation ever in history. So the wage pressure is huge. We have taxation going on gasoline, so 13 cents a liter here, that goes through the whole economy. So I am curious how you calculate taxes into our inflation figures, because it's definitely feeding in there. Every time a truck drives my lettuce across town, that's charging me more money. And then, so I don't know if you can even answer these questions, but financial stability in the era of higher interest rates. If you look at the US mortgage market, where I can get a 30-year mortgage at a fixed rate, and I know exactly what my financial impact is going to be for like a long period of time. We have variable rates and variable 5-year fixed rates, and then 1, 2, 3, 4, 5-year mortgages. Try to get a 10-year mortgage for a residential mortgage is nearly impossible, nearly impossible. So, you know, I think there's some reform needs to happen in the mortgage business so that we could have more stability in the era of higher interest rates. But could you answer the question about how tax fits into your calculations for inflation, please?
Yeah. Okay. I think there was about 3 different things in there. There was wages, lettuce being transported, and okay. So
Just talk about the lettuce.
The taxes. So to answer your question very directly, we take all fiscal policy, all government budgets, all tax policy, all of the policies that are announced in public, and they get fed into our forecast, including our forecast for inflation. So, but I think there's been a lot of discussion on this issue of the carbon tax and how that works. What's important to keep in mind, and I think this is the point you're making, is there's sort of two layers of effects. We call it sort of first round, second round effects. So there is the direct taxation effect on purchasing something like home fuel. This is the big debate right now, right? But the point that you're making is that that tax then becomes a cost for a business who uses transportation, for example, as one of their input costs. And then that adds to other input costs they have, and as it goes up, that business now needs to potentially pass on that added cost in the form of the price of their lettuce or whatever it is they're transporting, right? So there is 2 first round and second round effects on something like commodities for sure, particularly oil, transportation costs. Absolutely. The first round effects are much easier to measure. The second round effects are sort of what kind of, we call that kind of sort of that's the more sticky part of inflation. Somebody was asking me earlier, what is sticky inflation? It's when those sort of first round effects, those shocks that happen as a jump in oil price, start to trickle down and affect everything else, all the other input costs in the economy. So that's obviously more difficult to measure.
We have a question from Laurent here.
Hi, Laurent Meunier from Safe Pacific Financial. I'm also on the Advocis board here. Thanks for your time, and thanks to everyone else who got up early and joined us today and bought a ticket. Keep buying tickets. You were talking about the CBDCs, the central bank digital currencies, and you mentioned in there that Canadians had really said privacy is a huge concern on that.
Yep.
And as we saw a couple years ago, there was a big national protest, and a lot of those protesters were negatively affected through their mortgages and through their finances and trying to go after them financially. How can we ensure that the privacy and no political meddling happens in the programming of a CBDC, which can be programmed? So how do you ensure that if I protest the wrong thing, somebody can't just push a button and erase me?
Yeah. So I mean, that's the design challenge that Canadians have put to us, right? So we, as I said, we went and talked to Canadians about the concept of a digital dollar, and that was one of the concerns they said. I mean, one of the reasons I use cash is that I can maintain my privacy. There's no sort of record of me using the cash. So that's one thing Canadians have told us. So that's the challenge we have now. Can we design a digital version of cash that preserves the things that Canadians want about their cash.
And then how strong is the firewall between the Bank of Canada and some up-and-coming politician who's got an idea of how they want it to be, which would come from some sort of like ideological reasoning of, you know, this person is bad or whatever they're buying is bad, so we're going to shut them down, but this person is good and what they're buying is good, so, you know, maybe they get a higher interest rate programmed into their CBDC, and then these guys, maybe theirs expire if they don't spend it in X amount of time, or if they're, you know, buying cigarettes versus buying lettuce. Like,
yeah, well, I mean, you're asking me a question as though it's been built, and we haven't built a digital dollar yet.
well, it's been built in some countries.
It has. It has not been built in Canada. So it's difficult for me to answer a question, but I mean, I think what we've heard loud and clear from Canadians is that the level of interest I'm going to have in using a digital dollar will depend on whether you can preserve the things that I like about cash. So, you know, that was good feedback for us. We've got a design challenge. And again, as I said, at the end of the day, we don't decide to implement a digital dollar. That's a decision that's made by Canadians through their parliamentarians.
Thank you. We have a question over here. Yeah. Hi, it's Barbara Lee with Financial Hub Capital. I had a question. As an advisor, we've been told that the first generation is a generation that makes the money. The second generation is one that spends it, and it's very little is going to be left over for the third generation. So we've been told that there's about $1 trillion that's going to change hands to the second generation that may dissipate it all when we're talking about productivity. How do we maintain that next generation of this wealth transfer is actually going to keep Canada competitive and, you know, at least maintain the productivity and not just dissipate all that wealth and keep Canada being productive? Are there monetary policies that you can think of to put in place, or is that, you know, Minister of Finance? How do we keep productivity and not have it dissipated, that wealth?
Do you have an hour? Well, if I try and sort of combine the things inside your question there, I mean, I think what I would say is, if I use your model where there's a generation of wealth transfer, and we want to use that generational wealth transfer to address this challenge of productivity, I guess I would come down to what does that wealth transfer get spent on, right? You know, there are things that will contribute more to productivity than other things. What can monetary policy do? As I said, you know, monetary policy is not really well designed to affect levels of productivity. We have an effect on the demand side of the economy. We really need to focus on the supply side of the economy. I would come back to the response I gave Angelina. I mean, you know, what we're doing is trying to continue to talk about this issue, continue to raise awareness when we get to talk to people like you, when we talk to parliamentarians. So that's what we can contribute. I mean, the other thing we can contribute is, we know, I mean, you're small business owners. One of the things you need to make investments in productivity is certainty, and steady, stable, low inflation is an important part of that certainty to invest. So the biggest contribution we can make to boosting productivity in Canada is to do our job and get inflation back to target, which is what we're going to do.
Thank you, Carolyn. We have a question here. Sorry, Brandon first, and then we'll go to you next.
Hi, Carolyn. Thanks for sharing some time today, and great job up there, Angelina. My name is Brandon Chapman, founder of SAS Wealth Insurance. And back in July of 2020, Tiff Macklem said rates are low and they're going to be low for a long time. Many families and businesses made financial decisions based on those comments. Is there any liability with the Bank of Canada and the comments that are made? And secondly, how does the Bank of Canada define a long time? Thank you.
Great. I mean, I think the best way I can answer that question for you, Brandon, is to take you back to the time where we made those comments, where the governor made those comments, right? So at that point in time, we had about 3 million Canadians unemployed. We had another 3 million Canadians who were underemployed, who didn't have as much work as they wanted or needed. We had the sharpest downturn in a generation. We were staring down what we thought was going to be a deflationary spiral. We had a pandemic and no prospect at that point of a vaccine. So we did, the decisions we made were to support an economy that had effectively been shut down. So we did what we did at the time. I don't think we regret making those decisions at the time. 2 years was a long time for interest rates to be at the level they were. The good news is it worked. The Canadian economy, the world economy rebounded, the Canadian economy rebounded. We're out the other end. There's definitely some impacts that we need to deal with. We're doing that now.
Thank you, Carolyn.
Thank you for the question.
Thank you.
Floyd, sorry, go ahead.
Sorry, we have 1 minute left, so Floyd, it's got to be short and sweet. Sorry.
Well,
don't ask about productivity.
First of all, I would like to congratulate Carolyn in her new role, because I've worked with you when you were here with the BC Securities Commission and other roles that you had here. So it's good to see you now that Ottawa has recognized the talent. But as a person who has 250 employees, I am facing with the problem that all my employees have a vision of inflation that's just like I encountered in the 1970s, which was ahead of what you are. They're thinking 10%, you're showing 4%. Yeah. So when I do my payroll adjustments for next year, I have to deal with not your number, but the number they have in their head. So here's the issue I have for you. In order to stop that trend, which you're not stopping at the moment, not in the minds of the vast majority of employees, there were 3 things that happened in the 1970s. And those of you who are under 60, it was a history lesson. Those of us who lived through it, I'm talking reality. And it's very, very similar. 3 things happened. A substantial reduction in real estate values. In Vancouver, do the arithmetic, 30 to 40% assessment adjustment in 1 year. The second thing was massive unemployment. Because if there's unemployment, why are you asking for a raise? And the third thing is governments had to reduce the amount of spending. So how are we going to get over those 3 things? Because that's the only thing that stopped inflation at that time, those 3 things. It was caused by interest rates, but all those other things had to happen in order to get inflation. And we had the benefit of it for 40 years. So do you see any of those 3 things happening? Dramatic drop in real estate. If developers start collapsing, it's going to happen. Secondly, unemployment, because if people stop, if construction slows down, lots of unemployment. Thirdly, you're going to see, how do you convince governments to stop borrowing money and inflating the economy?
So, Carolyn,
we're out of time, like a minute, right? Well, so I'll give you a really short answer. Yeah, we are seeing the economy moderate. We are seeing monetary policy is having an effect. We are seeing the economy get back into a better balance of supply and demand, and we are seeing inflationary pressures come off. There's some similarities to the time you talked about. There's lots of differences too. So we are not forecasting the things you talk about, but we are expecting the economy to moderate, and we are expecting that moderation to help get inflation back down the rest of the way.
Thank you. Thank you so much. This really
Thanks for your
concludes
question.
our live Q&A session.